Imagine waking up tomorrow and checking the news, only to find out your city's power grid needs to grow by like 65%. And I mean a massively complex, multi-billion-dollar physical system that literally took over a century to build.
Yeah, and the craziest part is they don't have decades to do it. It needs to happen in, what, the next 48 months?
Right, exactly.
Yeah.
Which is just, it's wild. It sounds like science fiction.
It really does. I mean, you are talking about compressing a century of infrastructure, scaling into roughly half a decade.
But, it isn't science fiction. And it isn't some theoretical white paper either. That is the exact reality hitting Houston, Texas right now. The numbers we are looking at are completely tearing up the traditional rule book for how we think about American energy infrastructure.
Totally, because, well, for decades, the utility sector has been the financial equivalent of a slow-moving glacier.
Yeah, like you buy the stock, you collect your little dividend, and you just trust the math of a 1 or 2% annual growth rate.
Exactly. The foundational premise of a utility investment has always been its ballast, right? It's the shock absorber in your portfolio.
Right.
So when high-flying tech stocks are plummeting because of interest rate scares or whatever, your utility stock is supposed to just sit there, quietly keeping the lights on and mailing you a check.
A defensive play.
It is defensive. But what we are looking at today is something entirely different. The defensive playbook has just been thrown out the window.
Because we are stepping into this whole new era, right? We've got advanced manufacturing, artificial intelligence, these hyperscale data centers, and massive demographic shifts. And, well, those industries don't just want power. They absolutely devour it at a scale we have never seen before.
Yeah, they really do. And the companies that own the wires, like the actual physical bottleneck between a billion-dollar AI server farm and the electricity it needs to run, they're suddenly sitting on some of the most explosive growth profiles in the entire market.
And that brings us to the raw data we are unpacking today. Welcome to this deep dive. If you are a retail investor trying to figure out how to play the massive artificial intelligence and industrial manufacturing boom.
But maybe without taking on the terrifying volatility of semiconductor stock.
Exactly.
Yep.
If that's you, you are in the right place.
Today, we are ripping into the Q2 2026 earnings call transcript for CenterPoint Energy. They trade under the ticker symbol CNP.
And we are going to cut through all the dense Wall Street utility jargon, hit the data hard, and give you an opinionated, actionable take on whether this grid giant actually belongs in your portfolio.
Right, we're looking at the actual physics and finances of what they're building. So CenterPoint is a fascinating case study because their footprint puts them at ground zero for this demand shock.
Yeah, they are primarily a transmission and distribution utility.
Meaning they don't really generate the power. Right, for the most part, they don't own the power plants generating the electricity. They own the poles, the wires, the transformers, and the substations that deliver that power to homes and businesses, primarily in the greater Houston area.
Which operates on the Texas ERCOT grid.
Exactly, and also up in Indiana, which we'll get to.
So they're the delivery mechanism, basically the toll road for electrons. And to understand if this company is actually turning this unprecedented demand into real bottom line value for you as an investor, well, we have to start with the scoreboard.
Headline numbers.
Yeah. How did the core business actually perform over the last 3 months? Let's dive straight into the second quarter numbers. What happened versus what Wall Street analysts were modeling?
Right. So if we look at the raw profitability, CenterPoint reported GAAP earnings per share, and GAAP, meaning generally accepted accounting principles, of 37 cents for the second quarter of 2026.
Okay, 37 cents.
But management and analysts almost exclusively focus on their adjusted non-GAAP earnings per share, which came in at 40 cents.
Okay, hold on. I always put my skeptical hat on when a company tells me to ignore their official accounting numbers and look at their custom non-GAAP numbers instead.
That's a fair point.
Because it usually means they're trying to hide a massive expense by just calling it a one-time event, right?
Right.
Why is there a 3-cent gap here? And why should we accept the 40-cent number as the real truth?
It is a vital question, and as an investor, you should always scrutinize that bridge between GAAP and non-GAAP. But the thing is, in the highly regulated utility sector, non-GAAP adjustments are often genuinely necessary to see how the underlying pipes and wires are actually performing.
Okay, so what's driving it here?
In CenterPoint's case, the 3-cent difference is driven by a few very specific structural changes to their portfolio that kind of obscure their day-to-day operations.
Like what kind of changes?
First, they are in the process of divesting some of their local distribution companies, or LDCs. Specifically, they are selling off their Ohio natural gas business.
Got it.
And so the tax expenses and transactional friction from executing that sale hit the GAAP numbers this quarter. Second, they are executing some corporate restructuring tied to their Louisiana and Mississippi operations just to streamline their footprint.
Right, makes sense.
And finally, they pulled out the financial impact of some temporary mobile generation units that regulators have asked them to remove from their official rate base.
Okay, so they are selling off a gas business in Ohio, they're tweaking their southern operations, and dealing with some regulatory accounting on backup generators.
Yeah, that's pretty much it.
I can see why you would strip those out if you just want to know how much money the core Texas and Indiana electrical grids are printing. So let's anchor on that 40 cents of non-GAAP earnings. To really understand a utility, you have to break down the mechanics of exactly what pushed those earnings up or down compared to last year. How do they get to 40 cents?
Well, utilities are essentially giant, heavily regulated math equations. You can track every penny of profit back to a specific operational or regulatory lever. Let's look at the tailwinds first.
The factors driving earnings higher.
Right. The biggest driver by far was rate recovery and growth, which added 10 cents of favorability compared to the same quarter last year.
10 cents is huge. I mean, if the total earnings are 40 cents, that 10-cent boost is effectively a 25% tailwind just from regulatory math.
It really is.
But let's break down the mechanics of rate recovery for the listener, because it is literally the fundamental engine of how a utility makes money. How does that 10 cents actually materialize in the bank account?
It all comes down to the regulatory compact. A utility like CenterPoint is a natural monopoly. I mean, it doesn't make sense to have 5 different companies building 5 different sets of power lines down your street.
Right, that would be chaos.
So the government grants them a monopoly, but in exchange, the government, specifically the Public Utility Commission, gets to strictly cap how much profit they make.
Right, they can't just jack up prices 50% tomorrow just because they feel like it.
Exactly. When CenterPoint spends $1 billion building a new substation, or maybe replacing aging wooden poles with steel ones, they don't get to just instantly charge customers for it.
How do they pay for it then?
They use their own capital or they borrow money to build the infrastructure. Then they have to go to the regulators in what is called a rate case.
Okay, a rate case.
Right. They open their books, show the regulators the $1 billion they spent, and prove that the spending was prudent and necessary for grid reliability.
And if the regulators agree?
If they agree, the regulators allow the utility to add that $1 billion to their rate base. And then the utility is legally permitted to charge customers a slightly higher rate to slowly recover that $1 billion over decades, plus a guaranteed regulated return on equity.
Which is usually what, around 9 or 10%?
Yeah, usually around 9 or 10%. That is rate recovery. For CenterPoint, they successfully implemented updated higher rates in the first quarter of this year, and they also had some additional regulatory filings take effect in June.
So because they spent billions upgrading the grid in the past, regulators reviewed the receipts, stamped them approved, and allowed them to slightly increase the toll on the toll road.
Exactly.
And we are now seeing a full 3 months of those slightly higher tolls flowing directly to the bottom line, which generated that 10 cents of favorability.
Precisely. It is a testament to the fact that their relationship with regulators in Texas and Indiana is highly constructive right now.
Which is important.
Very. The regulators understand the grid needs massive investment, so they are allowing the rate recovery to happen smoothly. But the second tailwind on this earnings call is perhaps even more impressive because it is entirely within management's day-to-day control.
Oh, what is that?
Operations and maintenance, or O&M, brought in 2 cents of earnings favorability.
2 cents. How exactly are they squeezing an extra 2 cents out of daily operations? Did they lay people off?
No, it wasn't headcount reductions. It was driven primarily by a highly efficient, accelerated vegetation management program they launched last year.
Vegetation management. Man, Wall Street loves to dress things up. That is the ultimate utility jargon for trimming trees, right?
It is trimming trees, yes, but the mechanics of how and why it matters are critical to grid economics.
Okay, break that down for me.
When a massive storm hits, the primary cause of outages isn't usually the wind knocking over a pole. It is a tree branch snapping and falling across a high voltage line, causing a fault, or what is known as an arc flash.
And that trips the breakers and shuts down the neighborhood.
Exactly. And when a neighborhood loses power, the utilities costs absolutely explode. Reactive maintenance is incredibly expensive. You have to roll out emergency crews, often paying double time or hazard pay.
Right.
You have to replace damaged transformers that blew when the tree hit the line. It is chaotic and costly. What CenterPoint did was deploy advanced technology, likely including LIDAR scanning from drones or trucks, to map the exact distance of millions of tree branches from their thousands of miles of lines.
Oh, wow.
Yeah, they identified the highest risk encroachment areas and spent the money up front to aggressively clear those corridors.
So they spent a little bit of money on proactive maintenance last year, which dramatically lowered the amount of emergency reactive maintenance they had to do this quarter.
Right.
And that efficiency flowed straight through to the bottom line to the tune of 2 cents a share.
Exactly. It proves management is operating the existing asset base really tightly. They aren't just relying on rate cases to grow, they are actively optimizing their daily cash burn.
Okay, so that is 12 cents of positive momentum between the regulatory rate hikes and the high-tech tree trimming. But obviously, they didn't beat last year's numbers by 12 cents. There were some headwinds dragging the numbers down, right?
Yes, there were two primary headwinds, and each cost them about 1 cent of earnings. First, weather and usage were unfavorable compared to the exact same period last year.
The weather. I mean, it always feels like a bit of a cop-out when a multi-billion-dollar corporation blames the clouds for missing a number. How much can a few mild days really hurt the bottom line?
In the utility sector, it changes everything, and it comes down to a metric called degree days. Utilities track heating degree days in the winter and cooling degree days in the summer.
Okay.
It is a measure of how far the average daily temperature deviates from a baseline of 65 degrees Fahrenheit. If it is 95 degrees outside, that is 30 cooling degree days.
And in Texas, the summer is entirely defined by cooling degree days. Air conditioning isn't a luxury, it's a matter of survival.
Right. And air conditioning is incredibly energy intensive. CenterPoint's revenue model for residential customers still has a volumetric component, meaning the more kilowatt hours you use, the more you pay.
Right.
During this specific second quarter, the weather across both their Texas and Indiana service territories was measurably milder than the scorching heat they saw in Q2 of the previous year.
Oh, so because it wasn't blazing hot, residential customers didn't run their HVAC systems quite as hard.
Exactly. Less electricity flowed through CenterPoint's meters, which directly translated to a 1 cent drag on earnings.
You know, you can't control the weather. If it doesn't get hot, the meters don't spin as fast. But what about the other headwind?
The other 1 cent drag came from higher interest expense. Utilities are heavily indebted entities by design. They borrow billions to build infrastructure.
That's right.
CenterPoint had some new long-term debt issuances recently to fund their grid upgrades. Now, they did manage to offset some of that pain by brilliantly managing their short-term debt. They lowered their commercial paper balances, which are highly sensitive to the Federal Reserve's interest rate hikes.
Okay, sorry.
But ultimately, in the current macroeconomic environment where borrowing costs are just elevated, servicing that new long-term debt costs them an extra penny per share.
So if we look at the whole picture, the underlying mechanics of this quarter are actually incredibly bullish for you as a shareholder.
I would say so.
The things management can control and the structural tailwinds they are riding are massively overpowering the macro environment. It's kind of like getting a substantial promotion at work. That is the rate recovery and the tree trimming efficiencies.
I like that analogy.
But you realize you were paying a tiny bit more on your credit card interest. And it rained a few weekends, so you couldn't run your side hustle. The promotion far outweighs the credit card fee and the weather.
That is the exact mathematical takeaway. The structural gains overpowered the transient drags. And this strong foundational performance is exactly why management used this call to reiterate their full year 2026 non-GAAP EPS guidance range of $1.89 to $1.91.
Hitting the midpoint of that guidance means they will deliver 8% earnings growth over their 2025 actual results. In the utility space, an 8% return is excellent execution.
Definitely.
But here's the thing. Earning a few cents on rate cases and optimizing tree trimming is standard blocking and tackling utility mechanics. It is good, but it isn't revolutionary.
No, it isn't. It's just solid management.
But the real fireworks on this transcript, the numbers that caused Wall Street analysts to frantically update their spreadsheets, had nothing to do with the past quarter. They were about a structural, tectonic shift in demand that is bearing down on them right now.
Yeah, this is the single most critical theme you need to understand if you are analyzing CenterPoint or, frankly, any company involved in American power generation today. We are talking about the load growth explosion.
Let's get into the mechanics of this Texas-sized demand. CenterPoint operates the transmission and distribution network for the greater Houston area. Houston is the energy capital of the world. It is rapidly expanding in population, and critically, it operates under the ERCOT grid.
Right.
ERCOT stands for the Electric Reliability Council of Texas. Before we get into the bombshell numbers, explain why ERCOT is unique, because it dictates how this growth is happening.
Sure. The American power grid is essentially divided into three massive interconnected systems: the Eastern Interconnection, the Western Interconnection, and Texas.
Texas just has to be its own thing.
Always, right. ERCOT manages the flow of electric power to more than 26 million Texas customers, representing about 90% of the state's electric load. What makes ERCOT utterly unique is that, for all intents and purposes, it is electrically isolated from the rest of the country.
Meaning they don't really share power across state lines.
Exactly. Historically, this was done to avoid regulation by the Federal Energy Regulatory Commission, or FRC. Because the electrons don't cross state borders, interstate commerce laws don't apply in the same way.
Right, a classic Texas move.
But the physical consequence of this isolation is that ERCOT has to be entirely self-sufficient. When demand spikes in Houston, they can't easily just import a massive amount of excess power from Louisiana or Oklahoma. They have to generate and deliver it internally.
Which makes the numbers management dropped on this call absolutely staggering. On this earnings call, CenterPoint revealed the results of their submissions to ERCOT's new Batch Zero process for approving large load projects.
Yeah, and to contextualize Batch Zero, you have to understand the chaos that was happening prior to.
What kind of chaos?
Because Texas is so business-friendly and because power prices are generally competitive, ERCOT was just being flooded with requests from massive industrial players, crypto miners, data center developers, hydrogen producers. Everyone wanted to connect to the Texas grid.
A gold rush, basically.
It was. The queue of applications became so massive and so bloated with speculative, maybe we will build it projects, that ERCOT's engineers couldn't process the studies fast enough to figure out if the grid could actually handle it all.
The toll road was getting jammed with people who didn't even have cars yet.
Precisely. So ERCOT paused the traditional process and created Batch Zero. It was a filtering mechanism. They told developers essentially, if you want to connect to our grid in the next few years, you have to prove you are serious.
No more tire kickers.
Right. You have to submit hard data, meet stringent financial and physical criteria, and we are going to study the most viable projects in one massive batch to determine what grid upgrades are needed.
And when the dust settled on Batch Zero, CenterPoint announced they had submitted a jaw-dropping 17 gigawatts of large load projects into this process. And of that, management expects 14 gigawatts to be officially eligible and moving forward.
Yeah, 14 gigawatts.
Now, a gigawatt is one of those words that gets thrown around in the media, but it is deeply abstract. Help us visualize the physical reality of 14 gigawatts. What does that actually mean for CenterPoint?
To understand how shocking that number is, you really have to look at the baseline. CenterPoint's Houston electric system has been operating, expanding, and adapting for over a century. 100 years of building lines to every new suburb, every new hospital, every skyscraper in downtown Houston.
Right.
Today, their current peak demand for that entire system, meaning every single air conditioner, factory, and light bulb running at absolute maximum capacity during the hottest hour of a Texas summer afternoon, is 21 gigawatts.
Their entire century-old system maxes out at 21 gigawatts.
Yes. And from this single Batch Zero process, they are expecting to add 14 gigawatts of new massive industrial demand.
That is a 65% capacity increase over their current system peak.
It is mathematically unprecedented. I mean, for a business model that traditionally aims for 1 or 2% annual load growth, 65% is a complete paradigm shift.
It is like waking up and discovering your single-family home now has to support 3 new stories, and you have to figure out how to build the plumbing to reach them.
That's exactly it.
And the timeline makes it even more intense. Management expects nearly all of these projects to be energized by the end of 2030. They are taking a century of infrastructure scaling and compressing a 2/3 expansion into 48 to 60 months.
which requires a level of supply chain procurement, engineering, and capital deployment that CenterPoint has never executed before.
Okay, I have to stop right here, because as an investor, this is where the red flashing warning lights start going off for me.
Why is that?
Tech companies, data center developers, and industrial manufacturing plants are famous for overpromising. They stake their claim in the grid queue, they issue a glossy press release about a new billion-dollar campus, but if interest rates rise another point, or if their AI software doesn't sell, they quietly cancel the project.
Right.
Why should I believe these 14 gigawatts are actually getting built? How do we know this isn't just a bunch of speculative vaporware?
It is the single most important question to ask, and Wall Street analysts hammered management on exactly this point during the Q&A portion of the call.
Right.
If CenterPoint builds the infrastructure for 14 gigawatts and the customers don't show up, everyday ratepayers would be left holding a massive bag. But CenterPoint came prepared with the mechanics of how they have de-risked this growth. They are not taking these companies at their word.
Show me the actual mechanics of the guarantee.
So, to be eligible for this 14 gigawatts of batch zero load, and to get CenterPoint to start ordering materials, these industrial customers had to sign take or pay facility extension agreements.
What does that mean legally? Take or pay?
It means the customer is legally obligated to pay for the infrastructure CenterPoint builds for them, regardless of whether the customer actually finishes their data center or uses the power. But, a contract is only as good as the ability to enforce it. So CenterPoint required massive financial security up front. Management stated on the call that they have already secured approximately $900 million in customer cash commitments, letters of credit, and parental guarantees.
Nearly $1 billion in hard financial security is already locked down.
Yes. A tech company does not hand over hundreds of millions of dollars in non-refundable letters of credit unless their board of directors has fully greenlit the construction and the capital is already deployed.
Right, they have real skin in the game.
Exactly. Furthermore, CenterPoint gave an update on the regulatory status of this load. 10 gigawatts of this demand is already designated as base load by ERCOT.
Meaning what, structurally?
Meaning the complex engineering studies required to ensure these massive facilities won't destabilize the frequency of the Texas grid are completely approved. The engineering is done. Work on the targeted system upgrades has already begun.
And what about the other 4 gigawatts?
The remaining 4 gigawatts is classified as studied load, which means one of the 2 required ERCOT studies is already approved, and it is moving through the final regional planning allocation process right now.
So the engineering is validated by the state, and $1 billion in financial security is sitting in CenterPoint's accounts. The demand is locked in. It is physically happening.
Not a doubt.
But let's pivot to the most counterintuitive and honestly, the most fascinating part of this entire transcript. We need to talk about the impact this 14 gigawatts is going to have on everyday people paying their power bills in Houston.
The residential impact.
Right, because the prevailing narrative in the media right now is, well, panic. You read the financial press, and the story is always, data centers are draining the grid, they're stealing all the power, and they're going to force utility companies to hike rates on everyday families to pay for the massive new power lines.
Yeah, the assumption is that corporate expansion punishes the residential ratepayer.
Exactly. But CenterPoint management specifically addressed this on the call, and the math says the exact opposite.
It does. It completely flips the narrative. And to understand why, you have to understand the fundamental difference between fixed costs and variable costs on the electrical grid. Massive industrial load, when managed correctly by the utility, actually saves everyday people money.
Walk us through the physical and financial mechanics of how massive corporate power consumption lowers my residential electric bill.
Think of the electric transmission system like a massive multi-lane toll road. It costs billions of dollars to build the pavement, maintain the bridges, and pay the toll booth operators. Those are the fixed costs.
Okay.
The toll road costs almost the same amount to maintain whether there are 1,000 cars on it or 10,000 cars on it. The asphalt doesn't care.
Right. The costs are fixed. And right now, the fixed costs of the Houston grid are divided among all the current drivers, the millions of residential homes and commercial businesses.
Correct. Your monthly tower bill is essentially your share of the toll to keep the road open. Now imagine a massive fleet of thousands of heavy-duty semi-trucks representing these 14 gigawatts of data centers and factories starts using the road 24/7.
Now, obviously, these trucks need some new infrastructure. You can't just dump 14 gigawatts onto the existing wires without melting them.
Exactly. These massive loads require some specific new on-ramps and off-ramps. They need dedicated high-voltage lines and specialized substations built directly to their facilities. CenterPoint has to spend capital to build those targeted upgrades.
Sure.
But here's the critical mechanism. Once those specific on-ramps are built, these industrial giants are pulling incredible volumes of electricity continuously, day and night. Data centers don't turn off when the sun goes down.
So they are paying massive continuous tolls into the system.
Precisely. Because the overall fixed cost of maintaining the main highway system hasn't changed that much, but the total amount of toll revenue flowing into CenterPoint has skyrocketed thanks to these massive industrial users. The per unit cost of the entire system drops.
Oh, I see.
The massive new customers absorb a disproportionate share of the fixed costs.
They dilute the cost rate of the entire grid.
Yes. CenterPoint's management ran the macroeconomic models on this dynamic and stated clearly on the call that they estimate this 14 gigawatt load will save residential and commercial customers over $5 billion over the next decade.
Let that sink in for a second. $5 billion in savings for normal residential and commercial customers, simply because tech and manufacturing giants are arriving in such volume that they are footing the bill for the baseline infrastructure.
It's pretty amazing.
It is a historical irony. Usually, everyday consumers are the ones subsidizing corporate build-outs through tax breaks or higher costs. But the mechanics of utility rate making actually reverse this. The corporations subsidize the grid for the consumer.
And CenterPoint is uniquely positioned to execute this efficiently because of the physical layout of their existing system. Not every utility can handle a 65% increase this smoothly.
Why is CenterPoint different?
CenterPoint noted that their Houston electric system currently has about 10 gigawatts of existing hosting capacity.
What does hosting capacity mean in engineering terms?
It means the raw physical headroom currently available on their existing transmission lines and substations before components start overheating. Because of decades of prior investments, their network is incredibly robust.
So they don't have to start from scratch.
Right. They don't have to build entirely new 345 kilovolt backbone transmission lines from scratch across hundreds of miles to accommodate this first wave of growth. They can route this new demand through existing high-capacity corridors with relatively minor localized upgrades.
Which is why they stated they can connect this massive new load at a capital cost of less than $60 million per gigawatt. That is a highly disciplined, hyper-efficient way to deliver growth. They are maximizing the utilization of the physical assets they already own.
Exactly. And it is crucial to note that this explosion in demand isn't just happening at the massive transmission level scale. The transcript detailed that even at the local neighborhood distribution level, demand is accelerating rapidly.
The distribution level being the lower voltage wires on the wooden poles in your neighborhood, compared to the massive steel towers of the transmission system.
Right. Management anticipates an additional 2 gigawatts of localized distribution level demand over the next several years.
What is driving 2 gigawatts of growth at the neighborhood level? I mean, you can't put a hyperscale data center on a residential street.
No, it is being driven by two massive macroeconomic trends. First, the reshoring of advanced manufacturing. Companies are actively moving supply chains back to the U.S. from overseas to avoid geopolitical risk.
Oh, interesting.
And they are building medium-sized fabrication plants, warehousing, and logistics hubs throughout the greater Houston area.
And the second trend?
Second, it is just driven by the sheer demographic reality of Texas. Massive, continued population growth means new subdivisions, new schools, new grocery stores, all of which require distribution-level power.
So even the projects that fall just below the 75 megawatt threshold, the threshold that requires ERCOT's complex batch processing, are piling up.
Yeah, they noted they are already tracking 500 megawatts of these smaller, localized industrial requests. It is growth compounding on top of growth.
Wow. And before we close the book on the load growth story, it is imperative to point out that this is not exclusively a Texas phenomenon for CenterPoint. While Houston is the headline, they also operate the electric and gas utility in Indiana, and they are seeing massive transformational opportunities in that territory as well.
Right. The transcript highlighted a specific project in their Indiana electric service territory. Management literally called it a transformational large load opportunity. They are tracking one single project that represents 1.5 gigawatts of demand.
A 1.5 gigawatt request from a single customer. To put that in perspective, a typical nuclear reactor produces about 1 gigawatt.
Right.
This one customer is asking for the equivalent of a nuclear plant and a half of power. If executed, it would be the single largest load CenterPoint serves in that entire Midwestern region.
It's massive.
And Indiana operates on a completely different grid system than Texas, right?
Yes, Indiana operates within MISO, the Mid-Continent Independent System Operator. MISO manages the grid across 15 states in the middle of the country. And unlike ERCOT, MISO is heavily interconnected with the rest of the Eastern grid.
So how is CenterPoint handling this 1.5 gigawatt request? Are they waiting for MISO to do a batch zero process?
No, the MISO queue works differently, and CenterPoint is already moving aggressively. Because they have secured initial financial and contractual commitments from this customer, they have already begun the physical execution phase.
Oh, they're already building.
They were securing their formal spot in the MISO interconnection queue, and crucially, they are already ordering the long lead materials.
The long lead materials. This is a massive bottleneck in the global energy transition right now.
Yeah.
We are talking about high voltage transformers and specialized switchgear.
Exactly. You cannot just go to a hardware store and buy a 345 kilovolt transformer. These are massive, highly engineered pieces of equipment that require specialized, grain-oriented electrical steel.
And I imagine that steel is hard to get.
The global supply chain for that steel is incredibly constrained right now. If you order a massive transformer today, the lead time for delivery can be anywhere from 2 to 4 years. By ordering these components now, CenterPoint is de-risking the timeline for this 1.5 gigawatt project.
And they noted they are actively engaged with multiple other counterparties for even more large load projects in the Indiana area. Okay, so we have firmly established the fundamental narrative. CenterPoint is sitting on historic, once-in-a-century growth across multiple jurisdictions. 14 gigawatts in Texas, over a gigawatt in Indiana, plus distribution growth.
The demand is unquestionable.
But now we have to face the physical and financial reality of that demand. Building out a grid to support a 65% capacity increase, engineering new substations, pouring concrete, pulling thousands of miles of high-voltage wire, ordering multi-million-dollar transformers costs billions and billions of dollars in hard capital.
That it does.
Which brings us to the most critical pivot point in this analysis: management guidance and capital strategy. Because the paramount question for you as an investor is this: how is CenterPoint going to pay for all this construction without destroying the value of your stock?
It is the absolute crux of utility investing. High capital expenditure, or CapEx, is a double-edged sword. On one hand, it is the only way a utility grows. You spend CapEx to build infrastructure, that infrastructure enters the rate base, and your regulated earnings grow. That is the goal.
But the other edge of the sword is how you fund that CapEx in the short term.
Precisely. If a utility needs $5 billion to build lines and they don't have the cash flow to support it, they are forced to go to the open market and issue millions of new shares of stock.
Which dilutes the existing shareholders. It is like having a pizza cut into 8 slices, and suddenly management cuts it into 16 slices to hand out to new investors. Your slice of the company's profits just got cut in half.
Dilution is the enemy of retail utility investors. So analyzing how a utility plans to fund historic growth without diluting the equity is paramount.
Let's anchor ourselves with their earnings guidance first to see what they're promising. We mentioned earlier they reiterated their 2026 non-GAAP EPS of $1.89 to $1.91. But their long-term outlook is incredibly aggressive for a regulated utility. Management is targeting 7 to 9% annual EPS growth from 2026 through 2028, and they expect to sustain that 7 to 9% compounding annual growth rate all the way through 2035.
A full decade of visibility on 7 to 9% compounding earnings growth. If you apply the rule of 72, a quick mental math trick where you divide 72 by the annual growth rate to see how fast an investment doubles, a 7 to 9% growth rate means CenterPoint expects their earnings power to completely double in roughly 8 to 10 years.
Wow.
That level of long-term regulated predictability is incredibly rare in the current market.
But achieving that doubling requires massive physical capital.
Yeah.
And on this call, CenterPoint dropped a massive financial update. They officially increased their 10-year capital investment plan by $1.2 billion.
That $1.2 billion bump brings their total expected 10-year capital spending plan to a staggering $66.7 billion.
Where exactly is this new $1.2 billion going? Are they just throwing money at the 14 gigawatt problem?
No, it is highly targeted. The $1.2 billion increase is split into two distinct buckets. The first bucket is $800 million dedicated specifically to the targeted transmission upgrades needed to connect that 14 gigawatts of new batch zero load in Texas.
Okay.
This covers the specialized substations and high voltage interconnects we discussed earlier.
And the second bucket?
The remaining $400 million is allocated for a completely different physical challenge. The Downtown Houston Revitalization Project. They are executing a massive, complex project to relocate and modernize two major aging electrical substations in the heart of downtown Houston.
That sounds intense.
Yeah, on this call, they announced they have finalized the site selections and land acquisitions for these new facilities.
Building a high-voltage electrical infrastructure in the middle of a dense urban environment like downtown Houston has to be incredibly expensive. I mean, you are dealing with astronomical real estate costs, digging up paved streets, and routing lines underground through a maze of existing water and telecom pipes.
It is extremely capital intensive, which is why the budget for that project required a $400 million bump. But the net result of all this spending, the $800 million for the industrial load and the $400 million for downtown, is that CenterPoint now expects their Houston electric rate base to grow at a compound annual growth rate of over 18% over the next 3 years.
An 18% CAGR on a utility rate base is hypergrowth. That means the total value of the physical assets they earn a regulated return on is expanding by nearly a fifth every single year.
Yeah, it's massive.
But again, as a retail investor, hearing a management team casually announce they're increasing spending by $1.2 billion usually triggers a panic attack about equity dilution.
Right. You immediately assume they're going to issue a massive secondary offering of stock to raise the cash.
But on this call, the CEO and the CFO were absolutely adamant. They formally promised zero additional equity financing to cover this $1.2 billion increase. They are not selling a single new share.
Zero dilution.
My question is, mechanically, how is that possible? If you need over $1 billion in cash and you aren't selling stock and you aren't blowing out your debt ratios, where is the liquidity actually coming from? Walk me through the financial engineering.
The financial maneuvering here is truly a masterclass in utility balance sheet management. They aren't relying on a single magic trick. They are systematically pulling three distinct levers to harvest liquidity from their existing operations to fund this high return growth.
Okay, unpack the first lever. Where is the first chunk of cash coming from?
The first lever is a massive structural tax windfall. To understand this, we have to look back at the 2022 Inflation Reduction Act, which instituted a new corporate alternative minimum tax, known as CAMT.
The CAMT was essentially designed to ensure that massive corporations paying zero taxes because of various deductions had to pay a baseline minimum rate, right?
Exactly. It instituted a 15% minimum tax on the adjusted financial statement income of large corporations. Now, utility accounting is incredibly complex, especially regarding how capital expenditures and depreciation are treated for tax purposes versus regulatory purposes.
Sure.
Because of some initial ambiguity in the CMT rules, CenterPoint, acting conservatively, paid a substantial amount of CMT over the past couple of years.
I mean, better to pay the IRS up front than face massive penalties later if you calculate it wrong.
Right. But earlier this year, the Treasury Department and the IRS issued a critical clarification regarding how certain utility assets and depreciation schedules are treated under the CMT framework.
Oh, I bet I know where this is going.
Because of this new regulatory clarity, it turns out CenterPoint significantly overpaid. They are now anticipating a massive tax refund for those previously paid amounts, and they expect a large portion of that cash to physically hit their balance sheet in the third quarter of this year.
So just as they need hundreds of millions of dollars to start ordering transformers for data centers, the IRS is effectively handing them a massive refund check. That is incredible timing. It provides a huge, non-dilutive liquidity injection. What is the second lever they are pulling?
The second lever is strategic portfolio optimization through asset sales. We briefly touched on this when discussing the GAAP versus non-GAAP earnings. CenterPoint is in the process of divesting their Ohio Gas Local Distribution Company, their LDC.
Why sell a perfectly good gas utility?
Because it is a slower growth, lower return asset compared to the massive electrical expansion happening in Texas. By selling the Ohio gas business, they unlock a massive amount of trapped equity.
Makes sense.
On the call, management confirmed that the transaction has cleared all necessary regulatory hurdles and is firmly scheduled to close on October 1st of this year. The cash proceeds generated from that sale provide a significant near-term liquidity cushion that they can immediately redeploy into the high-return Texas electric grid projects.
It is textbook capital rotation. You sell the slow-growing asset to fund the hyper-growth asset, entirely avoiding the need to ask shareholders for more money. And the third lever.
The third lever involves monetizing equipment they already own but no longer need in their regulated rate base. Specifically, CenterPoint owns a fleet of temporary generation units.
What exactly are those? Are we talking about the backup generators you buy at a hardware store?
No, these are massive industrial-scale mobile turbine generators. Think of a jet engine strapped to a semi-trailer.
Oh, wow.
Following the catastrophic winter storm Uri in Texas, there was a massive regulatory push for utilities to acquire emergency backup generation to prevent the grid from collapsing during extreme weather. CenterPoint acquired these units and originally had them in their regulated rate base, earning a return.
But the regulatory environment shifted.
Yes. Recently, the Texas legislature and regulators changed the rules regarding how these specific temporary units are treated, essentially requiring CenterPoint to remove them from their regulated rates. So CenterPoint now has this massive fleet of highly valuable mobile power generation assets sitting on their balance sheet, not earning a regulated return.
So what are they doing with them?
They are actively marketing them on the open market. They're looking for either a long-term sublease agreement or an outright sale to a third party. And management stated they expect to have clear line of sight on a definitive deal for these units by the end of the first quarter of next year.
So when you stack it all together,
Yeah.
the massive CAMT tax refund arriving in Q3, the hundreds of millions from the Ohio gas sale closing in October, and the impending monetization of a massive fleet of mobile generators next year, they have systematically built a war chest of internal cash that completely covers the $1.2 billion CapEx bump.
Yeah.
They don't need to issue a single share of stock.
And the most impressive part of this financial engineering isn't just that they avoided dilution. It is that despite ramping up their capital spending to historic levels, the fundamental health of their balance sheet is actually improving.
Really? How?
The chief financial officer, Chris Foster, spent significant time highlighting a crucial credit metric, their adjusted FFO to debt ratio.
Let's break that down. FFO stands for funds from operations. In plain English, that is essentially the actual physical cash the business generates from its core operations, right?
Exactly. It is a cleaner metric than net income because it strips out non-cash accounting items like depreciation. The FFO to debt ratio is the metric that major credit rating agencies like Moody's or S&P look at to determine how safe a utility's bonds are.
Right.
It measures how much cash the company generates in a year compared to its total outstanding debt.
If that ratio drops too low, the rating agencies downgrade your credit rating, your borrowing costs explode, and your earnings get crushed.
Right. And according to Moody's specific rating methodology, CenterPoint's FFO to debt ratio was 13.4% at the end of the second quarter. That represents a nearly 100 basis point improvement quarter over quarter.
For the listener, a basis point is 1/100th of a percentage point. So a 100 basis point improvement means the ratio improved by a full 1% in a single quarter.
Which is a massive move for a multi-billion-dollar balance sheet. And the CFO noted that with the expected CAMT tax refund hitting in Q3, they anticipate this key credit metric improving by another 30 basis points.
This is the definition of a Goldilocks scenario for a financial analyst. They are increasing capital spending by over $1 billion to chase unprecedented growth, yet their cash flow generation is so strong that their debt metrics are actually getting safer.
Exactly.
They noted they are firmly maintaining their target capital structure of 47% equity and 53% debt. They are not over-leveraging themselves to chase this 14 gigawatt dream.
And if we look just slightly ahead, the cash flow mechanics become even more favorable. We have talked about the capital required to build the grid for these batch zero customers, but we haven't talked about the revenue model once they are connected.
Whoa.
As CenterPoint connects this 14 gigawatts of new load over the next 5 years, they expect to collect approximately $6 million in new demand charges per gigawatt per month.
Okay, stop right there. A demand charge is a specific utility term that most residential customers don't understand because it isn't usually on a home power bill. Explain the difference between a volumetric charge and a demand charge and why it is so lucrative for CenterPoint.
It is a crucial distinction. As a residential customer, you generally pay a volumetric charge. You pay for the exact number of kilowatt hours of electricity you consume in a month. Think of it like paying for the gallons of water you use.
Okay.
If you go on vacation and turn everything off, your bill drops to almost nothing.
Because I didn't use any water.
Right. But massive industrial customers' data centers, factories operate differently. They require immense amounts of power instantaneously. The utility has to build massive infrastructure, huge wires, massive transformers, just to have the capacity to deliver that power the millisecond the factory turns on.
Oh, I see.
So industrial customers pay a demand charge. They pay a massive fee based on the absolute peak amount of power they might need, regardless of whether they actually use it continuously.
To use the water analogy, a demand charge means you aren't paying for the gallons of water you use. You are paying a massive fee for the utility to build a 10-foot wide pipe to your house, just in case you ever want to drain a lake. You pay for the size of the pipe, not just the water flowing through it.
Precisely. It is a fixed, recurring revenue stream that guarantees the utility recovers the cost of that massive infrastructure. And CenterPoint expects to collect $6 million in demand charges per gigawatt every single month.
Let's do that math because it is staggering. $6 million times 14 gigawatts of approved batch zero load is $84 million a month in pure recurring cash flow. That is over $1 billion a year in new cash flow just from the demand charges of these specific customers.
It is a phenomenal cash tailwind that accelerates heavily into 2027, 2028, and 2029 as these facilities come online. And the most bullish detail management dropped on the Q&A portion of the call is that they haven't even fully modeled the benefit of those massive demand charges into their long-term financial outlook yet.
Really?
Yeah, they are keeping their models conservative.
Meaning there is still massive upside potential to their earnings that isn't even baked into their current 7 to 9% growth projections. Plus, the transcript noted they identified another $700 million in highly targeted, high-return investment opportunities for 3 gigawatts of demand that didn't qualify for batch zero.
That's right.
They aren't adding that $700 million to the official CapEx books yet, but it is sitting right there, waiting in the wings. They explicitly stated they maintain visibility to at least $10 billion of additional upside capital investment opportunities through 2035.
The runway for capital deployment, which again is the fundamental engine for how utilities compound their earnings, is virtually endless for CenterPoint right now.
Okay, we have systematically unpacked the data. We have the underlying operational numbers, which were incredibly solid with rate recovery and proactive vegetation management driving the core earnings.
Yep.
We explored the massive 65% capacity growth story driven by 14 gigawatts of AI and industrial demand, heavily de-risked by $1 billion in customer cash commitments. And we scrutinized the flawless balance sheet mechanics, proving they can fund $1.2 billion CapEx increase through tax refunds and asset sales without diluting the stock.
It's a very complete picture.
It is time to synthesize this data. Let's make a call on CenterPoint Energy.
If we aggregate all the mechanics and the financial engineering we have discussed, it paints a very definitive picture of where this company sits in the macroeconomic landscape.
I'm going to take a highly opinionated stance based on the math we just reviewed. For you, the retail investor trying to navigate this market, CenterPoint Energy is the ultimate picks and shovels play for the massive data center and advanced manufacturing boom. But crucially, it is wrapped in a highly regulated, mathematically predictable package.
Exactly.
If you want to invest in the AI revolution, you usually have to guess which software company will write the best code or which semiconductor company will design the fastest chip. It is a highly speculative, volatile game.
It is a guessing game where the losers get wiped out.
Exactly. But you don't have to guess who wins the AI war to make money here. Whether Microsoft, Google, or some unknown startup wins the software race, they all have to build hyperscale data centers. They all have to plug those servers into the wall. And in the most critical energy and manufacturing hub in the country, Houston, Texas, that wall is physically owned, operated, and tolled by CenterPoint Energy.
The math strongly supports that thesis. If you are analyzing CenterPoint's position in the sector, you are looking at an incredibly rare breed of equity. They have unparalleled visibility into tech-like hyper-growth metrics.
Right.
A 65% capacity bump in half a decade is a growth curve you typically only find in speculative software or biotech startups. But unlike a startup hoping for a breakthrough, CenterPoint has the physical contracts and nearly $1 billion of customer cash in hand to prove this demand is locked in.
And the execution is what truly separates them. The fact that they are engineering a $1.2 billion upgrade to their grid without issuing a single new share of stock, all while improving their credit rating, proves that management is treating shareholder capital with extreme discipline.
I completely agree.
If you want high visibility, 7 to 9% compounding earnings growth, heavily supported by massive, undeniable industrial expansion, but you want to sleep at night without the heart-stopping volatility of tech stocks, the data in this transcript suggests CenterPoint is executing the playbook perfectly.
They are managing a historic hyper-growth transition with the steady, conservative, financially disciplined hand of a legacy utility operator. It is a highly potent, asymmetric risk-reward combination for a portfolio.
Which brings us to our final thought. I want to leave you with a fascinating historical and economic concept to chew on based on the utility math we unpacked today.
The shifting dynamic of grid economics.
Exactly. For the last 5 years, the dominant narrative in the financial press, and honestly in political circles, has been fear. We are constantly told that power-hungry tech companies, massive AI data centers, and the reshoring of heavy manufacturing are going to break the American grid.
That's the story you hear everywhere.
The assumption is that this corporate gluttony for electricity is going to strain resources to the breaking point, and ultimately, it is going to force utility companies to hike rates on everyday families to pay for the massive new power lines and substations required to support it.
The fear is that the consumer will subsidize the corporation.
But when you look at the raw mathematical models CenterPoint presented, where massive continuous industrial load absorbs a disproportionate share of the fixed costs of the grid, fundamentally diluting the cost rate for everyone else, and actually saving your residential customers $5 billion over the next decade, it completely inverts that narrative.
It introduces a paradigm where industrial expansion is a deflationary force for the residential ratepayer.
So the provocative thought I want you to explore on your own is this. We know the American power grid is aging. We know it requires hundreds of billions of dollars in modernization to handle the electrification of our economy and to survive increasingly severe weather events.
Right.
Could the corporate energy boom, the insatiable, massive appetite of tech giants and advanced manufacturing, actually be the unexpected financial savior of the U.S. grid?
It is a profound structural question.
Are the tech giants, in their race for AI dominance, inadvertently providing the exact massive influx of capital needed to hurricane-proof the power lines going to your neighborhood? Are they the ones paying to modernize the infrastructure for the rest of us? Based on the hard data coming out of Texas, the math suggests the answer might just be yes.
It completely reframes how we should view industrial load growth in this country.
Thank you for joining us on this deep dive. We hope we helped you cut through the dense Wall Street static, translate the utility jargon, and find the actual actionable signal in the data. Keep questioning the narrative, keep looking past the headlines, and keep diving into the raw mechanics of how these businesses actually work. We'll catch you on the next deep dive.